Have you ever wondered how billionaires seem to multiply their fortunes effortlessly? How do they turn debt, the very concept that scares most of us, into a money-making machine? Buckle up as we uncover the astounding truth that billionaires use debt not only to grow their wealth, but to catapult into new dimensions. Throughout history, pioneers like Elon Musk, Warren Buffett, and countless others have harnessed the power of debt to turn their dreams into reality. Today you'll learn how they use this financial tool strategically, and how you can do the same, no matter your current situation. Get ready to embrace a new perspective on debt, one that allows you to take control of your financial destiny. By the end of this video, you'll have the knowledge and confidence to embark on your own path to wealth, all while responsibly using debt as a catalyst. So, if you're ready to shatter old beliefs and discover the untapped potential of debt, stay with us. The concept of leverage debt. At its core, leverage debt involves borrowing funds to invest in income-generating assets, such as real estate, stocks, or businesses. Unlike traditional debt, where borrowing is viewed with caution, leverage debt is a calculated and strategic approach to financial growth. Let's break it down. Imagine you have a sum of money, say $100,000. Instead of investing it all directly into an asset, savvy investors use a portion of their own capital and borrow the rest from an external source, like a bank or financial institution. This creates leverage, the ability to control a more substantial asset with a smaller initial investment. Now, you might wonder, what's the magic behind this? The answer lies in the potential return on investment. If the asset appreciates in value, the investor stands to gain a substantial return on their initial investment, not just on their own capital, but on the borrowed funds as well. For example, if our initial $100,000 investment grows by 10%, it becomes $110,000. However, with leverage debt, let's say we borrowed an additional $300,000 to invest, bringing the total investment to $400,000. If the asset appreciates by the same 10%, the value becomes $440,000. Now, deduct the borrowed $300,000, and the investor is left with $140,000, a 40% return on their initial investment of $100,000. This showcases the power of leverage in magnifying gains. However, it's essential to note that leverage also amplifies risk. If the asset's value were to decline instead, the losses would also be magnified. Therefore, leveraging debt requires meticulous analysis, risk management, and a thorough understanding of the assets being invested in. Billionaires and successful investors have honed the art of leveraging debt to their advantage. They strategically deploy low-interest good debt and allow funds into various income streams to create a diversified portfolio. This mitigates risk and ensures that even if one investment falters, others can continue to thrive. Aspiring investors can learn valuable lessons from this concept. By embracing leverage responsibly, individuals can tap into a powerful tool that accelerates wealth growth. Education, research, and seeking professional advice are crucial steps on the path to becoming adept at leveraging debt effectively. Leverage debt, a financial mechanism that separates the ordinary from the extraordinary, as it empowers the elite to accumulate wealth on an unprecedented scale. So, if you're ready to take your financial journey to new heights, consider the strategic application of leverage debt in your investment endeavors. The power of good debt versus bad debt. Find out how you can identify the right kinds of debt that can open doors to extraordinary opportunities. Let's start with good debt, the financial ally of the wealthy. Good debt is a strategic and purposeful borrowing that is used to acquire income-generating assets or investments. Think of it as a financial stepping stone that propels you towards prosperity. Entrepreneurs and investors use good debt to acquire real estate, fund business expansions, or invest in stocks that offer long-term growth potential. The power of good debt lies in its ability to generate returns that exceed the cost of borrowing. For instance, low-interest mortgages allow you to own valuable real estate, and as property values appreciate, your net worth grows exponentially. The returns from these assets can often outweigh the interest paid on the debt, leaving you with a surplus of wealth. On the other side of the battlefield stands bad debt, the financial adversary of the uninformed. Bad debt involves borrowing for consumable items or liabilities that don't generate income or appreciate in value. This type of debt often comes with high interest rates, like credit card debt or personal loans to use for non-essential purchases. Unlike good debt, bad debt doesn't contribute to your financial growth. Instead, it becomes a burden on your financial health. Interest charges can accumulate rapidly, leading to a vicious cycle of debt that's hard to escape. Unchecked bad debt can hinder your ability to invest, save, and build wealth. The key to mastering the power of debt lies in discerning between good and bad debt. Good debt opens doors to opportunities, builds assets, and creates a pathway to financial independence. Conversely, bad debt traps you in a cycle of financial stress and limits your potential for growth. It's essential to wield the power of debt responsibly. Before taking on any debt, consider its potential to enhance your financial position and future prospects. Ask yourself, will this debt enable me to generate income or build valuable assets? If the answer is yes, then you may be on the path to good debt. The opportunities for everyday investors. Don't miss this crucial part, where we unveil how you can start using debt as a stepping stone toward financial abundance. Here are 5 powerful ways to use debt to build wealth. Leverage in real estate. Real estate is a prime example of how debt can be used to create significant wealth. By leveraging a small down payment, investors can acquire income-generating properties worth multiples of their initial investment. The appreciation of property value and rental income generated from these assets can lead to substantial returns on borrowed funds. Leveraged buyout, LBO. In the business world, a leveraged buyout occurs when a buyer acquires a company by taking on a significant amount of debt, using the assets of the acquired company as collateral. The buyer plans to pay off the debt using future cash flow from the acquired money, ultimately gaining controlling interest and potential future profits. Short selling. Short selling involves selling borrowed stocks with the anticipation their value will decline. If successful, the investor can repurchase the shares at a lower price, pocketing the difference as profit. While risky, this strategy exemplifies how debt can be used to capitalize on downward market movements. Margin account. Margin accounts offered by brokerage firms allow investors to borrow money against their existing assets, amplifying their trading capacity. Margin trading can increase the size and speed of trades, potentially leading to greater profits. However, it also comes with increased risk as losses can be magnified. Using debt for living expenses. High net worth individuals can use debt strategically to fund their living expenses while minimizing taxes. Instead of selling assets for capital gains, they can use margin loans or lines of credit backed by their assets to cover their expenses, taking advantage of lower tax rates on certain forms of income, or avoiding taxable events altogether. Now that you know the secret behind Billionaires' success, it's time to take action and unlock your financial potential. Start your journey toward prosperity today.